So welcome. So I want us to do taxation of when a business or a partnership business is being converted into a limited company. So how do they file the annual return? So in our last session, we did taxation of partnership. So when a company or when a partnership is converted into a limited company, so how do we tax? For example, assume that during the financial year, it operated as partnership for 9 months. Then 3 months, end of the year, it was converted into a limited company. So here was operating as partnership and here as a company. We say that for tax purposes, a partnership or a sole proprietorship has no separate taxable capacity. But for a company, it is a separate, has a separate taxable capacity. Also, we see that in partnership, we have some expenses which are disallowable, such as salaries to partners. But to a company, salary to director, it's allowable. So how do you treat that? So I want us to open your notes. You have conversion of partnership into a limited company. Now, NB, I have given you a point note that for conversion, we start with the gross profit unless otherwise stated, even if you are given a complete record. So it's easier when adjusting for conversion of partnership to a limited company to start with the gross profit, then you raise allowable expenses. Instead of starting with the net profit, adding back these allowable expenses, not unless otherwise stated. And then some expenses are allowable to company, but disallowable to partnership business, such as salaries to partners, also rent expenses when the building is owned by the partner. Good, so open with me that question, December 2012, question 3B. December 2012, question 3B. Also, the question is also in your notes. And you're told that Samuel and Verum have been operating Saver Enterprise, a partnership business from 1st of January 2010, sharing profit and losses equally. The following was the firm income statement for the year ended that 1st of December 2011. What is your question? So we have the income statement, we have the sales closing stock, less all that. So since you are given the net loss, that means this one is a complete record. It's a complete record. Now let's go directly to the additional information. The business was converted from a partnership into a limited company in the name of Saver Limited with effect from 1st of July 2011. Fully owned by Samuel and Verum, who became directors. The ownership in share was agreed at 55% and 45% for Samuel and Verum respectively. So they converted the partnership into a limited company on 1st of July 2011. When does the year end? Just look at their financial year end. It's end on that 1st December. But they converted on 1st of July 2011. How many months end of the year? 6 months. So that means during that financial year, because the financial statement given there was for the year ended that 1st December 2011. So that means for the first 6 months, they operated as a what? As a partnership. Then for the last 6 months, as a what? As a company. Good. Number 2, the business was housed in a building owned by Samuel. Samuel is one of the partners, for which rent of $450 per month was paid. Now, let's argue the case of partnership. One of the partner owns the building. So that means the partnership will have to pay rent. Who will you pay rent to? To Samuel, of which for tax purposes, a partnership or sole proprietorship, there is no separate legal identity between the partner and the business. So in short, Samuel is the business. Are you together? But business is paying Samuel the rent. So from one pocket to another pocket. So that means that rent for partnership becomes a desirable expense. But when it's converted into a limited company, there is separate legal identity between now Samuel and the company. So that means the rent paid by the company will be allowable expense, but the one paid by partnership becomes a desirable what? Expense. Good. Yeah, I think that number 2. The business was housed in a building owned by Samuel, for which rent of $450,000 per month was paid. This rent was included in rent and rates expenses for the year. Number 3. Legal expenses include 3.6 paid to a law firm for defending Samuel in a case where he had been sued for breach of contract. Legal cost. Will it be allowable or disallowable? Will it be allowable or disallowable? That one will be disallowable. We say that any expense of wrongdoing, this was breach of contract. Are you together? Yes, there was a breach of contract. Any expenses for wrongdoing becomes a disallowable expenses. Good. Number 4, consultancy fee includes 2.4 paid to Eri and Associate for computerizing survey limited operation. Eri and Associate is owned by Veron's wife. We did again. Being owned by Veron's wife, that one has no effect. But you told that consultancy fee includes 2.4 paid to Eri and Associate for computerizing survey limited operation. Survey limited is the company, right? So we computerized the company. That means the partnership was what? There was still analog, right? Together. But this cost incurred to computerize, now it will be treated as a preliminary expense. Yes, it's not a allowable expense. So it's a preliminary expense or what we call a capital expenditure. Number 5, marketing and advertising expense represent the cost of construction of a billboard in February 2011. So that means marketing and advertisement becomes a disallowable. Why? Billboard, it's a what? We see that billboard neon sign to a company, that one is an asset. And they claim wear and tear. So therefore, it's a capital expenditure. So that means that cost of marketing and advertisement, we are told that represent the cost of construction of a billboard. A billboard to a company or neon sign, it's an asset. And it qualifies for wear and tear. Good. The billboard was to be designated every year. Every year. So that means this one is a long-term asset. Number 6, closing stock in trading account was stated at selling price, which was 20% above the cost. In short, the closing stock was overstated. How do you adjust that? So that means that one will have effect on our gross profit. Salaries and wages include, we have salaries to both partners for the 6 months to 30th of June 2011, 4.8 in total. Then there is salary paid to each director for the 6 months to that 1st December, 2.4 million. Number 8, capital allowances for the year were agreed at 5.6 million. Assume all revenue and expenses accrued evenly. What do you mean by evenly? Evenly means you prorate. If you're given the revenue for the year and you want to get for 6 months, you just take 6/12. That means you prorate. That's what you mean by occurred evenly throughout the year, unless otherwise stated. Required, number 1, Savel Enterprise taxable profit for the 6 months period 30th of June 2011. Also allocation of partners, allocation of profit or loss for partners in one above, and then Savel Limited, that's the company. So how do you prepare that? So we said that, I gave you an NB, that for conversion, we start with the gross profit unless otherwise stated. So how do you determine that? So computation of taxable profit or loss for the year ended 31st of December 2011. So here we had the partnership business. And then we have company. Partnership was for the first 6 months. Also company for 6 months. So we start with the gross profit. How much was the gross profit? Yeah, we said that for conversion, we start with the gross profit, unless otherwise stated. It was 69, 160, 69, 160. How do you get gross profit? To get the gross profit is sales minus cost of sales. How do you get the cost of sale? Opening stock plus purchase minus closing. But you're told that closing stock was overstated by 20. So that means this gross profit need to be adjusted. Are you together? Let's go to note number 6. Closing stock in trading account was stated at selling price, which was 20% above the cost. So if you overstate the closing stock, you also overstate the gross profit. How is that? So we minus. Okay, how much was the closing stock? How much was the closing stock? We note number, okay, first of all, let's go to the closing stock. It was 19. Now, this 19,200 was overstated by 20%. So that means this one is the same as 120%. What about 20? You see, if you look for 100, that means you're looking at the cost. But in this case, we want the overstated element. So 19,200 is the same as 120. We want that 20. So that means our closing stock was overstated by how much? That's 200. So in short, this is what you do. You take 20 over 120, you minus and times 19,200. You get that too? That's 200. Now, actually, this is another challenge, usually, and usually tested in most of the question, where the opening stock was overstated, closing stock was overstated, purchase was overstated. That's what will be tested. Now, how do you adjust for that? You just create your own scenario. Assume the sales was 1,000. Then you want to deduct the cost of sales, because you'll be given where the opening stock or the closing stock or the purchases, they're either overstated or understated. So what's the effect to the gross profit, or what is the effect to the profit? To get the cost of sales, you take opening stock plus purchase minus closing. Let's just create the dummy figures. Assume the opening stock was 200, purchases 300, closing stock 100. So how much will be your cost of sale? It will be 400. So how much will be a gross profit? It will be an amount of 600. Now, in this case, we are told that closing stock was overstated by 20. Now, you want to test what will be the effect of overstating the closing stock to the profit. So we assume sales still remain to be 1,000. Opening stock 200, purchases 300. Now, let's overstate closing stock. Maybe you put 150. Let's assume now it's 150. So how much will be a cost of sale? 500 minus 150, you get 300. And so your cost of sale will be 350. How much will be a gross profit? 650. Now that's what I was saying. If you overstate the closing stock, what will be the effect to the gross profit? Also, the gross profit will be overstated. And that's what you're saying, that this 69,160 was overstated. So that's why we're deducting that overstated amount. So how much was the adjusted gross profit? So it's 69,160. You minus that 2. Yeah, 20 over 120 times 19 to is that 2. So how much is the adjusted gross profit? Now that 65 is now what you apportion. You divide by 2. 6 months, 6 months. So what do you get? This one is, sorry? 980. That 2. They say that you start the gross profit. Then you raise allowable expenses. Now you can raise allowable expenses. So now let's go to the income statement. Go to the income statement. And allowable expenses, we have salaries and wages. Salaries and wages. How much is our salaries and wages? 26,400 minus. Let's go to note number 7. Note number 7. In note number 7, you're told that salaries and wages include salary to both partners for 6 months to 30th of June 2011, 4.8 in total. So that salary to partner becomes a allowable expense. Then the second bullet, there is salary paid to each director. Salary paid to each director for 6 months to that 1st December 2011, 2.4. How many directors do we have? 2. The 2 partner became the director. So how much will be the total director salary? 48. I repeat again. We read number 7 again. Salaries and wages include the salary to both partners for the 6 months to 30th of June 2011, 4.8 in total. So in total, you raise the salary to both partners. Also, you deduct salary paid to each director for 6 months to 31st December 2011, 2.4. But 2.4 was to each partner. And I mean to each director, and we have 2 directors. So in total, it will be how much? 48. So that you get the salary paid to other employees other than the owners of the company. Then what you get, you divide by 2. 6 months, 6 months. So what do you get? We have 8400, 8400. Then salary to partner is disallowable, but salary to director is what? Allowable, but it's purely allowable for the company. Yes, that I had to deduct it because if you take 26,400, you raise 48. That means this 48 you also apportion to both partnership and the company. So if first of all you admit all the salaries, you get the salary to other employees, you divide by 2. Then director salary is allowable expense, but only to the company. So we have director's salary, an amount of 4.8. If you don't deduct this, that means you'll be apportioning this 4.8 into 2 businesses. Good. Rent and rates. So the other expense we have is rent and rates. Let me separate the 2. Rent and rates. How much was rent and rates? It was an amount of 5.56. Now we go to note number 2. Note number 2. The business was housed in a building owned by Samuel, for which rent of $450 per month was paid. This rent was included in rent and rates expenses for the year. So we have rent and rates. So first of all, you want to determine how much is the rates. So first of all, you minus rent. How much is the rent per month? $450. For the whole year, you multiply by 12. That's 54. So 56 minus 54, 200. So that means the rates for the year was 200. Then you divide by 2. 100, 100. Now we go back to the rent now. Rent, we see that the building is owned by one of the partners. So that means the rent for the past 6 months becomes a disallowable expense, but the rent paid by the company, that is separate legal identity, becomes allowable expense. So the rent expense, you take 450, you multiply by 6, which is 2.7, right? So, but that one is only for the company, 2.7. The other 2.7 for the partners, it's an income to one of the partners. So it will go to the partners allocation schedule as part of specified sources of income. Office expenses. That one require no adjustment. So it's 7.8, you divide by 2, you get that in? That's 6, right? Sorry, 39. Computer maintenance. Computer maintenance. Computer maintenance was an amount of 84.60. So it will be how much? 84.60. You take that one, you don't apportion. There is something I mentioned. Lakini hamukuchukulia serious, hamukushika venye nilisema. Can we go back to note number 4? Let's go back to note number 4. That statement was saying that consultancy fee includes 2.4 paid to Eddie and Associate for computerizing Savile Limited. There is something I mentioned that if we computerize the company, that means partnership was what? Analog. Now we have computer maintenance. That expense purely is a total company expense. Then we have telephone and postage. And postage. So it's an amount of 3.8. You divide by 2, you get an amount of 19. General insurance. General insurance is an amount of 28.90. You divide by 2 and you get 14.45. 14.45. Website hosting. Website hosting. Only for the 22.10 you divide by 2. 11.05. Does website have anything to do with computers? Nothing. Like for example, our website, we don't maintain our website. We have someone who does that, who is not part of KCE. Most of the advertisement run, we have entities who does that. So it's not a must that you have to have a computer for you to have a website. It's like, for example, so you had an email, kitambo, ulikuwa na computer. Yeah. So website hosting, it's not a must that you have to have the computers for you to have a website. Yeah. Marketing and advertisement. That one becomes a what? A desirable expense. Can we go back to note number 5? Note number 5. Marketing and advertising expense represent the cost of construction of a billboard. And we say that billboard is an asset which will pay for wear and tear. It's a capital expenditure. So therefore, it's a desirable expense. And then we have legal expenses. Legal expense was an amount of 7.2 minus there was cost incurred for the breach of contract. That's note number 3. Legal expense include 3.6 paid to a law firm for defending Samuel in a case where he had been sued for breach of contract. So you minus 3.6 and you get 3.6. Then you divide by 2. 3.6 divided by 2 get how much? 1.8. 1.8. Then you also have medical expenses. Medical expenses an amount of 2.4. Divided by 2, you get 1.2. 1.2. Then we have consultancy fee. Consultancy fee was an amount of 8.4. You raise the capital expenditure. Yeah, that's note number 4. Consultancy fee includes 2.4 paid to area and associate for computerizing server limited. Yeah, that's a preliminary expense or a capital expenditure. So you raise 2.4.8 and then your portion. 29.99. Yeah, 29.99.6. And then the other expense we had was bank charges. So it's 1920. You divide by 2, you get 8. 960, 960. Loss from farming. That one is disallowable. Eh? Yeah, remember you see that farming income is a specified source of income, and you cannot offset one income against another income. So loss from farming will not be part of operating expense. So therefore it's disallowable. VAT paid, disallowable. Any expense relating to tax is disallowable. And then VAT is not an expense. Are you together? VAT is not an expense because it's the amount you collected on behalf of the government. It was never your money. So when you submit, don't treat it as an expense. As an expense, good. Depreciation, it's a disallowable expense. Single business permit. Yeah, that's allowable. You cannot operate your business without a license. Eh? Yeah, single business permit. So you take an amount, is it 2,000? 2,000 divided by 2, you get 1,000. You get 1,000. Visiting, so that one is also allowable expenses. Water and electricity. 1.6, you divide by 2, or 6 months, 6 months. You get an amount of 800. 800. We have another expense. Note number 8. Capital allowances for the year were agreed at 5.6. So you don't have to compute wear and tear for specific asset. So they agreed, they provide an amount of 5.6. Capital allowances. So you take 5.6, you divide by 2, and you get 2.8. And that's how you get your taxable profit. That's how you get your taxable profit. Let me just give you the answer. This one will be 4570.4. This one will be a loss of 11,389.6. Then you add. Can you go back where you had the gross profit? Below the gross profit, this one was a complete record. Eh? They had recognized other specified sources of income. So we add other specified sources of income. To other specified sources of income, what did we have? Yeah, we had rental income. Rental income, an amount of 3, you divide by, now listen here. For the partnership business, these were the ring cents. And this profit, if now what the partners, you take them to the partners allocation schedule. But for the company, you can recognize other specified sources of income. An amount of how much? 1.5. Now, the other 1.5 for the partnership will go to the partners allocation schedule. Then you also had interest income. Interest income, an amount of 2.4, you divide by 2. So for the partnership, we don't include it here because this is a profit you take to the partners allocation schedule, and then you add other specified sources of income for the partners. You want to take it for the company, an amount of 1.2. So now give me the adjusted. Give me adjusted taxable profit. How much is that for the company? You're getting an amount of 90? Good. So you get an amount of 20? 27. The teacher is always right. And then I invested 2 hours trying to explain about the specified sources of income. And I give you an illustration. Let me repeat again. Why do we include other incomes? Because there are some scenario when you're given a complete record, you add them, then you less them, and then you add them back. I remember trying to explain why we do that. We say that you cannot offset one source of income against another source of income. Did I say that? These are specified sources of income. We say that we have farming income, investment income, property income, business income or from the business, and what? Post-employment income. Now, this taxable profit, the loss for the company, that's what we call the business income, of which they had a loss. But from other sources of income, you had a gain. You cannot offset one source of income against another source of income. Now, that means you are getting a negative, right? So that means you won't pay KRI anything. No. For KRI, this is what they do. This was a loss. You will not be taxed on this. Are you together? And this amount actually will be allowable expense for the next 4 years. But where you had other income, this is what now they will tax. You cannot offset one source of income against another source of income. That's for the specified sources of income. So this is what they'll tax. So they'll take 30% of 2,700. Now you know. Now let's prepare the partners allocation schedule. How will we tax the partnership for the past 6 months? This was the partnership for the past 6 months. So how do we tax them? We prepare the partners allocation schedule. It's only for the first 6 months. We had 2 partners. We had Samuel and Veron. And we have the total. What do you start with? Salaries, commission, bonuses, all that. Now let's go to note number 7. Note number 7. Salaries and wages include salaries to both partners for 6 months to 30th of June 2011, 4.8 in total. The total was 4.8. So this will be an amount of 2.4, 2.4. The first paragraph here told that they were sharing profit and losses equally. Then we add interest on capital. We didn't have. You raise interest on capital. Interest on drawings. Did we have that? No. And then you get profit or all share. So you see that for you to determine the profit or all share, always leave a gap there, because you see here they made a profit. If they made a profit, it's not necessarily they have to share profit. They can even be sharing losses. If they get a loss, it's not necessarily that here they'll share loss. They can also even share the profit. So how determine that? So you determine the taxable profit here. Now from the partnership business. From the partnership business, the taxable profit was how much? 45,70.4. But you see, when they're determining this profit, their salaries was disallowed. You remember that? So now the question is, if we could have paid them this salary of 4.8, could they have shared the profit or loss? That's why we're saying that you take 4.8 plus or minus X, you should get 45,70.4. So how much is your X now? If you take 4.8 plus or minus X, you should get 45,70.4. So how much is your X? Yeah, you get a negative, Negative 220.6, which is a loss. So being a negative, that means it's a loss share. And how are they sharing? Equally, divided by 2. 114 point, and it's a loss 114.8. So now give me taxable profit for each partner. This one is 2285.2, 2285.2. then you can factor in other incomes. Yeah, the other incomes. There was rental income. How much was the rental income? This is 3, you divide by 2. Partnership for the first 6 months was the amount of 15. So you take 15. Then we have 2 partners. They were sharing equally. So an amount of 750, 750. Also, there was interest income. 24 divided by 2, that's 1.2, 1.2. So for the partnership was 1.2. Then the partner, they were sharing equally. So it will get an amount of 600, 600. Also for the past 6 months, Samuel was allowed by receiving some amount from the partnership business. So you also recognize it as an income. That's why here he treated it as a desirable expense, because we're going to a pocket of an individual partner, that's Samuel. So there was another rental income. So you take 450, you multiply by 6 for the partnership business. That was an amount of 2.7. And that's how now you get the adjusted taxable profit. 6335 point. You minus 2700. That is 635 point. That's simple. So we can take 3 minutes. Just try to look at what we have done. Now, rows from farming. You see, we are considering specified sources of income. So they never made an income, they made a loss. So that one did not factor it in under other incomes. It was a loss. Now, what could happen if you're not given capital allowance? You calculate. I'm taking break, not you. So kindly try to look at what you have done. You don't have to copy the question. The solution is already in your notes. So I have provided another illustration in your notes, so you can go through that. The one for me, 2017 question 3B. Then we'll discuss it later during our revision. Now let's look at taxation of group of companies. Now, group of companies, this is where there exists a relationship between the parent and subsidiary. So we have the holding company or the parent company, and then the parent company has other subsidiaries. And now note this, that for tax purposes, there is no group element of taxation. So, the KRA does not, or the taxman does not recognize the group aspect. You cannot consolidate income for tax purposes. Rather, he will assess each company individually, the parent individually, the subsidiary individually. Now, what accountant does, how you adjust for intergroup transaction, maybe intergroup sales, unrealized profit, intergroup balances. Now, for taxman, because for them, they know that these are an individual. This is an individual. Any transaction between the two should be a business to business transaction. It's only as an accountant you know that this is a parent, this is a subsidiary. So intergroup sales you eliminate. For tax purposes, there is nothing like that. So any transaction between the parent and the subsidiary will be treated as a normal business to business transaction. Good. So let's discuss that. Now, in general, the law does not allow consolidation of income tax returns. Therefore, each company is assessed separately for tax purposes, and the Revenue Authority does not recognize the group aspect of taxation. Dividend paid by one resident company to another is exempt from corporation tax if the recipient company controls 12.5% or more of the voting power of the paying company. Intergroup transactions are treated as a normal business to business transaction. So there is no special treatment. Now, what's the difference between branch and subsidiary for tax purposes? A branch. What's a branch? Branch is a segment of another business. What about a subsidiary? Is a company being controlled by another company, right? Now take a scenario where we have an unresident company. That means the company was incorporated. Give me an example of a company incorporated in another country, but have some branches in Kenya. Kasnev, where? Hiyo haikai kitu ya huku. Jumia, For example, let's take Jumia or even Coca-Cola. Then, now Jumia is a foreign company, right? So if they make a profit, so they have a branch in Kenya, and you have someone in charge of Kenya's operation. So that means they also have to prepare their financial statement, because they're generating income in Kenya and they have to file the returns. Now, their profit will be taxed at how much? That 7 point? Higher. Take the same scenario now. Jumia acquires another company incorporated in Kenya, XYZ Limited. They acquire 90%. So that means XYZ Limited becomes a what? A subsidiary too. But you see, XYZ was incorporated in Kenya. In short, it was born in Kenya. So this is a subsidiary, but Jumia is a what? Is a branch. Are you together? Jumia is a branch in Kenya, but it acquired another company. Are you together? So now this company becomes a subsidiary. Now, what's the difference now between a branch and a subsidiary? I've already given you one difference. Actually, two differences. What's the difference? Good. Jumia is an unresident company. What about XYZ Limited, the subsidiary? It's a resident. Therefore, another difference, resident company will be taxed at 30%. Non-resident will be taxed at? Correct. So now let's look at those differences. Now, a branch is an unresident company, but a subsidiary, it's a resident company. Therefore, for branch, it will be taxed at that 7.5. Subsidiary will be taxed at 30%. Then for branch, profit are not subjected to withholding tax. But for subsidiary, how do the subsidiary remit their profit to the parent or to the share? Okay, parent is the shareholder. Are you together? They remit in forms of the dividend, of which dividend are subject to what? Withholding tax. Now for branch, they don't pay withholding tax. I mean, they don't pay the dividend. So what happens? They transfer the retained earnings back to the head office. Are you together? But for the company, they transfer that amount to the shareholders in form of the dividend, of which dividend are subjected to the withholding tax. Another difference is that branches are restricted to some expenses, such as interest and management fee. We come to discuss that later when we're talking about the capitalization. Yeah, when a company is not incorporated in Kenya, and then they use debt to finance their asset in Kenya, the interest will be restricted. But for subsidiary, there are no such restriction. The other difference is that for branches are not subjected to the capitalization rules. Come to discuss what is capitalization and what we call anti-avoidance tax measures. But for subsidiary, they are subjected to the capitalization rule. Then for branches, do not suffer compensating tax consequence. Yeah, that's the trade-off between the tax paid and the dividend paid. Then for subsidiary, it does not suffer consequence of compensating tax. I will discuss compensating tax, shortfall distribution of dividend, and then capitalization and avoidance measure. That's another topic. Good. May 2014, question 5. Question 5B. That one use a past paper. It's not in your question paper. It's not in your notes. Yeah, May 2014, question 5B. I think I had already shared all the notes. Yes, if you don't have the notes, that means you are not in my group, because we are using the same notes we are using in our last session. We're using the same notes. What we are sharing, what we are doing, the notes we are using in our last session is the same we are using. Now, let's start with question 5A. Now, question 5A is saying that with reference to taxation of non-resident company in your country, distinguish between a branch and a subsidiary. That's 5A. Distinguish between that is 27. Hapa imepangwa wapi? December 20. There is some confusion here now. And request them to take a screenshot. So, you distinguish between a subsidiary and a branch? What's the difference? Branch? Wacha kuangalia wale. Hizo mbili ile ingine nayo inakuwa the vice versa Haya, vice versa, that 7.5 ni gani? Good. Now let's go to part B of the question. Part B. ABC Limited was incorporated in Kenya in 2000. So that means ABC Limited is a resident company. The company subsequently transferred the head office to Tanzania. Even if you transfer to Tanzania, you are born in Kenya, are you together? So you are Kenyan residents. But retained subsidiary XYZ Limited in Kenya, had another subsidiary in Kenya. So both of them, they are Kenyan company. Both of them, they are resident company. But one is a parent, the other one is a subsidiary. For the year ended that 1st December 2013, the following results of parent company and the subsidiary have been presented to you in Kenyan shillings. So we have the income statement. Now, under the income statement, we have incomes. For incomes, we have gross profit. Now, if you look at that statement, does it look like a complete or incomplete record? That one is a complete record. So being a complete record, now we start from tumetoka conversion of partnership into a limited company. Now this one you are taxing what? These are a group of companies. Are you together? So being a complete record, you start with the net profit. Are you together? Net profit, you add back desirable expenses. Now let's start with the incomes. Under the incomes, we have gross profit. Yeah, that's an operating income, so it's taxable. Gain on share disposed, that is non-taxable. Write it as NT. NT is a non-taxable. If you dispose share to a company, it's an asset. So they dispose shares. So that's a capital gain. So capital gain becomes a non-taxable income. Then we have recovery from insurance. There is something I mentioned about insurance compensation. So that if it was in relation to non-current asset, it's a non-taxable income. But if the insurance compensation was in relation to stock, it becomes a taxable. So we can leave that one in suspense. We'll be given more information on that. Goods transferred to subsidiary company. We transferred goods subsidiary company. We said that if you transfer the taxman does not know any transfer. These are one company, the other one is another company. So that transfer will be considered as a sale. Company A sold to company B. So those are normal sales. So therefore becomes a normal taxable income. Transfer, a good transfer to parent company. Also that one is a normal sale. Gain on sale of land. Non-taxable. Those are capital gains. Can you go and review the non-taxable incomes? Interest income from commercial bank and treasury bills. Those are taxable income, but they are specified sources of income. That's what we call investment income. Dividend and interest income. Gain on sale of building. Hey, so you have discussed two of them there. That's a capital gain. Therefore becomes a desirable, non-taxable income. We have loan interest. That one becomes a what? Non-allowable or allowable? This one is not an expense, it's part of the income together. So it's our own interest income, therefore becomes a space. Si hapo juu kuna interest income. And you have said they are part of special source of income. That means the company gave a loan to another entity and they received an interest. That's not an operating income, so it becomes a specified sources of income. It's an investment income. Bonus shares, non-taxable income. You see, the company issued some bonus share. They treat it as an income. That is not taxable. Then we have expenses. Director's fee is for expenses or either allowable or disallowable. So what you are concerned with, remember you're adopting the bottom up. So it's net profit, you add back disallowable expense. So you only be concerned with disallowable expense. So this director's fee is allowable, repair and legal is allowable. Preliminary expenses, disallowable. Preliminary expenses are capital expenses. So I will say is, and preliminary expenses are capital expenditure. So therefore becomes a disallowable expense. Retrenchment costs, allowable. Rent rates and insurance, allowable. Goodwill written off, disallowable. Legal and accountancy fee, allowable. Depreciation, disallowable. Can you write it as D? D. Interest on overdue VAT, disallowable. You see that any expense relating to tax is disallowable. Subscriptions, allowable. Donation, it depends. Good. You say that donation are only allowable if they are made to a charitable organization. Good. General admin expenses, allowable. Purchase of equipment, disallowable. You see, it's part of the expenses. So that one is disallowable. You claim for A&T. It's a capital expenditure. So for equipment, you can claim capital allowances. Loss of stock, allowable. Stock is part of current asset. And current asset, that means it's part of an operating asset. Mortgage interest. You see that interest is allowable. Right together. Interest on debt is allowable. Salaries and wages, allowable. Pension contribution, allowable. Total expenses. And now that's the total. Then you have net profit. So that's a complete record. Additional information. Goods transferred from the subsidiary or from the head office were marked up by 10% above the cost. Number 2, land sold was subject to legal charges regarding to the ownership. That's irrelevant. The building sold was donated by a non-government organization, the value of which was 3 million at the time of donation. The current value is 3.5. So there was a revaluation of 500. Revaluation does not affect our income statement. That one goes to the balance sheet. Are you together? Good. Number 4, loan interest income was respect to a loan obtained from the subsidiary company. Yeah, you see, there was a loan income there. You see that it's part of investment income. We are told that is a loan given to subsidiary company. So they paid back the interest, so which is an income. Bonus share were from the company in which ABC has a 70% control. How does that affect? The company were given some bonus share. So they treated that amount as an income. But yet, is it an income? It's not an income. So you just increase their investment. It's an asset because you are given the shares for free. So increase your ownership. Now the company that issued the share, they added their equity. Are you together? Yes. And the company that received, they added as part of investment. Rent, rates, and insurance. The building in which XYZ Limited operate is owned by ABC Limited, and XYZ Limited pays 100,000 per year as what? Okay, let me explain. The building the subsidiary is operating is owned by the parent. Are you together? So that means the subsidiary, they pay rent to who? Parent. How do you treat that? Allowable, disallowable? That's allowable. It's not partnership. Are you together? So in this case, there is separate legal identity between the parent and the subsidiary. It could have only been disallowable expense if it was a partnership business. Yeah. A donation were to orphanage for children, so therefore becomes a what? Allowable. Good. Number 8. Part of the equipment purchased valued 1.4 was from the subsidiary company. That is irrelevant. The rest of the equipment was imported from abroad and duty paid amounting to 130. This duty was omitted from the cost of equipment. Now, can you go to the 12 balance? To the income statement. Under expenses. Can you see the purchase of equipment? An amount of? It's an amount of 3.5. But you're told that the rest was imported, of which there was import duty of 130, which was omitted. So import duty is part of preliminary expense. They'll be incurred before you get the equipment. So therefore you capitalize. Can you go and add that? Add 130. Add 130. Adding purchase of equipment. 2.5. Good. Is that 2.5 or 3.5? It's 3.5. Good. Now let's go to note number 9. Retrenchment cost analysis. Golden handshake. Allowable, disallowable. Allowable, disallowable. You can guess. It's allowable. It's a? Mnasema it's allowable, mnasema disallowable. Oh, disallowable. You know, you can say it's allowable and disallowable. So it becomes a what? Yeah, that one is a disallowable expense. You know what's a golden handshake? And what's a golden handshake? It's a retirement. You see, now Umutu is no longer part of the asset of the company. It's an NSSF graduate. So in that case, if you decide to appreciate them, so that one is not an operating expense. Then we have pension payment. Yeah, that one is around. Yeah. Then number 10, we have rows of stock. Fire rates down warehouse, where goods are stored before they are transported to the parent company, as well as the subsidiary. VAT of 16% was not included in the stock, which was destroyed by fire. The VAT was not there. So they destroyed only the value which attached there was for the cost. So that, do you remember you had insurance compensation? Yes, so that means was in relation to what? Not VAT, loss of stock. So that means that insurance compensation, is it taxable income or non-taxable income? It's taxable. You see that? Insurance compensation in relation to the loss of stock becomes a taxable, but in case was compensation in relation to non-current asset becomes a what? A non-taxable. Are you together? Why is that the argument? That they tax for inventory. Your inventory was destroyed, ukakompensitiwa. It's like you sold to the insurance now wakakulipa. Are you together? Yes. So that's why they tax that amount. Because you had stock, it was destroyed. Then you are compensated. So insurance is like you sold the goods to the insurance company, and then they paid you, so you'll be treated as an income. Then number 11, mortgage interest was in relation to 2 residential houses and 1 office block. Is that one relevant or irrelevant? Very relevant. Let's read again. Is it that mortgage interest is a allowable expense? But we are told that mortgage interest was in relation to 2 residential houses and 1 office block. 2 residential houses. This is not part of operating. Are you together? And 1 office block. Office block will be allowable. For residential will not be allowable. Good. Number 12, 10 executive employees rendered their services to both the parent company and the subsidiary, and they received salary and pension, which were contributed by both companies. That is relevant because whether they provide the services, these are 2 totally different companies. So if they offer services, they are supposed to be paid. So that expense becomes allowable. required. Adjusted taxable profit or loss for ABC Limited and subsidiary XYZ Limited for the year ended that 1st of December 2013, and then tax payable, if any, by ABC Limited. So now let's adjust that. So here you have two companies. You have ABC XYZ. These are complete record. So we start with the reported profit. They had a net profit. Net profit. ABC an amount of 1.7. Here we have an amount of. Then you add back. What do you add back? Could you add back disallowable expenses? Disallowable expenses. So I hope you are marking the disallowable expenses. Number one, we have preliminary expenses, which was an amount of 150 and 150. Then we have 80. Then we have retrenchment cost. Is it allowable or disallowable? Cool. There was hardship, note number 9. Retrenchment cost analysis, there was golden hardship. There we had 2.5. And there you had an amount of 800. Then we also had goodwill written off. For the goodwill written off is an amount of 20. Here we had nil. Depreciation, also disallowable. This one was an amount of 230, 120. Interest on overdue VAT, also disallowable. Nil. And then we had 23. Is it 23 or 20? 23. And then we had purchase of equipment. An amount of 3.5. It was an amount of that 6. And now listen here. Listen here. Here we are adding back. You see, when they're determining this net profit, they had deducted equipment worth how much? 3.5. Are you together? So that's what we are adding back. We'll only factor in the additional 130 when claiming for wear and tear. Wear and tear. So here we are just adding back what they had deducted. Then we also have mortgage interest. Mortgage interest was an amount of 650. This was the ratio. That mortgage interest was in relation to 2 residential houses and 1 office block. So we use the ratio. So remember, you're adding back disallowable. Which one is disallowable? Residential. Good. So you multiply by 2 over 3. Sorry? 3. Salary is okay, pension is okay. So you have added back all the disallowable expense. Now, once you add back disallowable expense, what next? You raise allowable expenses never deducted. At most is 1. What is that? Wear and tear. Good. You add back disallowable expenses, then you raise allowable expenses never deducted, and that's wear and tear. Now, for wear and tear, Which asset do we have? It's only for the equipment, right? Equipment. Equipment at the rate of? Equipment. 10%. Yeah. Equipment, machinery, 10%. So you take 10%, 3.5, then you capitalize the other one, 130. So you take 10%, it will be 36. 363,000. Then we also raise. You say that you add back disallowable expenses. You raise allowable expenses never deducted. You also raise non-taxable income. You see, in this net profit, they had also included all the incomes. But of those income, we have some other incomes which are not taxable. So you raise non-taxable income. Now let's go to the incomes. Under the incomes which are non-taxable, gain on share disposed, gain disposed, an amount of 50, and you eliminate that. Also, there was gain on sale of land. Gain on sale of land, an amount of, is it 500,000 or 300? That's 300. Also, there was gain on sale of building. Gain on sale of building, an amount of 350. Then there was bonus share. An amount of 250. Then you also raise, what else do you raise? Specific or the specified income. You also deduct specified income. What did we have? Sorry? Yeah, interest income. We have from commercial bank. So here we have ABC, XYZ. Also, we have from the treasury bills. So we had an amount of 110 and 200. You eliminate them. And then there was also loan interest. Loan interest, an amount of 130. And that's how we get the taxable profit. Now that's what we call the business income from day-to-day operations. You get taxable profit. Once you get the taxable profit, what next? You add now the specified or the specific sources of income. Here we had interest income from commercial bank. You go and review the format again. I remember explaining why we have to first of all deduct and then we add back them afresh. What was the reason? You cannot offset. First of all, you have to determine this taxable profit is the income from day-to-day operation. Then you consider in the specified source of income separately. So we have from commercial bank and then we have treasury bills. Also, we had loan interest. Interest, an amount of 130. And that's how now you get the adjusted taxable profits. Now you have to get the tax expense. Both of them, they were resident companies. So you You don't combine. Are you together? Yes, because can you go back to requirement number 2? That's what the examiner expected you to do. The tax payable, if any, by ABC Limited. They expected you to take 30% and then you add your 2 profits so that they give you an X. You cannot consolidate the income for tax purposes. So you take 30% of ABC separately and then 30% of XYZ Limited. So XYZ Limited will pay 30, ABC that, but the parent company cannot pay on behalf of the subsidiary. Good. So you can look at that for a few minutes, then we do something else. So you can go and yes, have a question. So I had done another illustration there for May 2012 question 3. So you can go and try that as your assignment. So I want us to look at taxation of petroleum companies. I will start it next class. Another class, Yeah, because that one might take time because from 2015 it had become one of the major topics. I mean, one of major areas that have tested at advanced taxation. Yeah. So we'll be using the same notes, though I'll share other notes because that one will only take us 40 minutes. Also share notes for the next topic. So can you go and revisit on taxable income, and the format? Yeah, make sure they're at your fingertips. But I can see now they are starting to flow. So with time, you'll get it. Yeah, see now flow. I see, because we are repeating the same thing. Allowable, disallowable, taxable, and taxable, and the formats. Once you know that, that's all, right? Yeah, so we can start there from our next session.